Gagan Banga, we've been talking about businesses which are contracting, but if I look at the HFC business, it just amazes me that how evergreen the business is. I can put the numbers on an Excel sheet, draw the Excel sheet long and be assured of a 15 to 20% growth. Law of averages, Gagan, in any business they kick in, but for Indian housing finance companies, that does not apply.
Yeah, it does not, I would not say it does not apply. It does not apply to specific organizations which are positioned on the basis of both organizational capacity of credit as well as cost of funds. So long term, there is a big opportunity in India. We are a 9% mortgage to GDP country. Entry level strategies, salaries are rising. The age of the borrower has now fallen to between 30 and 35 years, and affordability in the segment that most housing finance companies cater to, which is homes of up to 50 lakh of rupees, has actually improved over the last 3 to 4 years with flat real estate prices, but salaries increasing. So all of this provides a lot of tailwinds. The government earlier this year did a lot by removing corporate tax for developers, service tax for buyers, improving income tax breaks. Recently, both the SEBI and the insurance regulator have also enabled more funding to come in, thereby increasing the overall liquidity with housing finance companies and thus enabling them to reduce costs. So all in all, I think it's a pretty solid case for at least the next 2 to 3 years for this growth of 20 to 25% to continue. And in the specific case of Indiabulls housing, I can say with a fair degree of confidence that in the near to medium term, this story which we've been carrying on now for the last 26 quarters should definitely go on, and we should be clipping growth of between 20 and 25%.
That's great, Gagan. And good morning at that. Your stock has returned a good 3 times since the listing in July 2013. And, you're already the second largest housing finance company in India. What's the trajectory? You just talked about future projections as well and where you see the growth coming. What's the strategy to increase your market share going forward from here?
The beautiful thing about our business is that even though we are the second largest and second largest by a mile from the third and the fourth, our incremental market share is only about 6%. The market itself, even through years when apparently real estate has been a little slow or there has been a lot of increased competition from banks, etc., housing finance companies have still been growing at 18-19%. And now with all that the government has done earlier in the year, my sense is that growth increases to 20-21%. That be the case, about 2/3 of our growth is anyways coming by the credit, underlying credit market for mortgages anyways expanding. So the good strong case and the competitive advantage that we have when we look at ourselves against other finance businesses is that a lot of our growth is actually coming by way of the market expanding and not necessarily by virtue of us gaining market share. And we also have a fair amount of players who are in some sort of an issue or the other, either capital or NPLs or something else, which is not enabling a lot of competition in the market. So if you look at the market out there, I actually see only 5 or 6 players in the market competing in the prime mortgage space. The important thing is to be able to get your cost of funds right to be able to participate in that market, which is very, very large. And my sense is that this 20-25% growth continues. And if that happens, then over the next 4 years or so, we can actually double our balance sheet.
So I've gotten that one number from you, Gagan. Presumably, 20-25% growth rate for the next 3-4 years seems to be okay. I think what's also happened, Gagan, and please give us your views here, is that fundraising for companies, NBFCs by and large has, and there are more facilities now. I mean, the recent bond market guidelines as well probably only aid to that. We've seen one housing finance company raise a reasonably large sum of via NCDs as well, and it got subscribed like crazy. So my question to you is, do you foresee almost zero problems when it comes to additional fund requirements for a company such as yours?
For well-rated companies, the market is definitely very strong. So I think for well-rated companies, the the issues would get back to being able to grow assets without credit quality. Historically, the emphasis has been on liabilities. Those who have focused on their liabilities, gotten their credit ratings up, gotten necessary equity capital and the resultant capital adequacy in place. My sense is now the next 2 to 3 years is all about efficiently growing the asset book without causing any credit issues. What generally happens is that if there is a lot of liquidity in the market, there is also a resultant lot of competition on the asset side, and generally the less efficient players land up reducing their credit standards. So that would continue to be the one variable that I will continue to watch out for and ensure that at least within Indiabulls housing we do not do that. But the rest of the market also needs to exercise adequate caution. The Reserve Bank actually has done a lot to support the sector by reducing risk weights across both housing loans as well as the construction finance portfolio that most of us have. But then we as practitioners have to live up to the confidence that the Reserve Bank has demonstrated and ensure that our credit standards do not dilute just because there is a fair amount of liquidity in the market. So it has to be a calibrated approach. The last 5 years one had to calibrate on the basis of how the liability side was evolving and the liquidity that was available. Now over the next 2 to 5 years one has to really look at how the asset side evolves.
Gagan, a slightly long-term question. What I want to understand from you is that are you committed to remain only in the housing finance business in Indiabulls, or somewhere you would also be looking at diversifying?
I can't hear him.
Gagan, okay, I think we've lost him there. Gagan, is my voice reaching you? Okay, we've lost him there, and I think just when I think I have an important question, somehow the connections always go haywire. There were question marks which were raised when they actually invested or took stake, I think, in one of the European banks, and the stock had really fallen off the cliff. So what I want to understand clearly from them is that are they only committed to stick to their housing finance business, or they are looking, or they've got aspirations to diversify into other businesses and they could be really moving out from their core investment? Hopefully we'll be able to get Gagan back and we'll get answer to that question. But in terms of some interesting did you know facts about Indiabulls Finance, they have one of the largest housing finance book in India. The stock is up 3x from July 2013, and reverse merger from flagship company of Indiabulls Group really created that. Okay, Gagan, I've been told that you can hear me now. So my next question, a rather important question, it may not talk about today and tomorrow, but in terms of an aspiration, do you have aspirations to expand your housing business, and are you looking at adding more business and verticals to it, or Indiabulls Housing Finance will only house the HFC business?
Now, clearly, Indiabulls Housing Finance in the near term is very, very bullish on the housing finance business. Over the 12 years that we have been doing lending, we've actually gotten out of a lot of other products that we used to do. We reverse merged the non-bank finance company into the housing finance company because that's the license that we believe has the highest level of scalability in the country. We've toiled to get to the highest possible credit rating, and now over the next 5 years we see an opportunity of getting past the 5,000 crore profit mark, getting past the 1,50,000 crore balance sheet mark, and these are large numbers in the context of the Indian retail financial system. If you look at the retail assets of most state-owned banks and even most large private banks, we would already be sitting at a number which is fairly larger to most of them. So the opportunity to build up a very nice retail portfolio is there over the next 3 to 5 years, and that clearly would be an area of focus. There would be opportunities as the financial sector keeps opening up. There would be opportunities to pursue other products either through new licenses or through just general participation in other asset classes. At this point in time, I do not see Indiabulls Housing venturing into anything new. I think the opportunity over the next 3 to 5 years is around mortgages, and we would like to remain focused on that.
The reason why I ask you this question is because in November 2015, you did acquire 40% in a British bank. Now, the market reaction that time was rather harsh. You came on air and you clarified the thought behind that. But what I want to understand from you is that in future course, would you be open to such strategic investments?
No, so the opportunity which Oak North Bank presented was not only an interesting financial investment opportunity, but more importantly, it was an opportunity to be able to build credibility, and which in due course of time can help you build a much wider and better liability structure. So that was the restricted necessity behind making that investment. Having made that investment at that time, and again today, I would like to clarify that our main job is to give out home loans and build a business around the mortgage opportunity that India presents to us. Everything else that we do from time to time is merely incidental to improve the overall quality of our business. At this point in time, actually, I do not see even a single rupee of capital being necessitated to get invested into anything else. So, yes, we have about 11,000 crores of net worth, and 100% of that is going to get retained in pursuing the housing finance opportunity in India.
So Gagan, one final question from my end. You've talked about a PAT growth of about almost 25% in terms of a guidance. What is it that you're working with when it comes to a number for your AUM growth for, say, the next 1 year or 2 years, in fact, on an average?
So, our AUM growth is expected to be in the range of 25 to 30%. We have been following that CAGR for the last 5 to 6 years, and my sense is that whatever is happening in the marketplace is only enabling us to do that a whole lot more efficiently and build a wider gap to our peers and next level players in terms of our cost of funds. So my sense is that 25 to 30% growth would definitely happen, and it would only happen with superior quality.
Okay, Gagan, great chatting with you. Thanks much for taking the time out and speaking with us today.
Thank you.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.